You know how we do it, like Ice Cube. I just bought 2 dividend stocks, high yielders. You know, my strategy for 2020, it is all about buying high yielding dividend stocks. So I'm going to show right now the 2 dividend stocks that I just purchased. I purchased shares of Universal Corporation and PPL Corporation. I bought Universal at a starting yield of 5.83% and PPL at 4.87%. The simple average of those is 5.35% starting yield, starting dividend yield cash flow that I can use immediately to pay my bills. This is the theme of 2020 for me, high yielding stocks. I'm going to share with you today the 9 high yielding stocks that I'm going to be focused on for 2020. These are the 9 stocks throughout the year that I'm going to stay laser focused on when I'm deploying capital in the stock market. And so I'm going to share today those stocks, but I'm also going to share the complete methodology that I used to select those stocks because a lot of analysis went into it, a lot of numbers crunching, and I want to share with everyone out there how I approach the stock market and how I came up with these 9 stocks that I will be focused on next year. And I'm already starting to focus on here in December. But before I even do that, I want to set the stage. How am I thinking about money this year? So I'm thinking about money strategically this way. First and foremost, you all know, or if you've been here for a while, you know that I work in the real estate space. I have another deal in escrow that is really important to me. That deal is going to require capital. It is going to require investment. And so first and foremost, when I look forward to 2020, it's kind of hard. It's hard for a dividend investor who loves putting as much money as possible into dividend stocks, but I'm going to have to restrain myself a bit. I'm going to have to refrain from putting as much money into dividend stocks as I otherwise would have. Why? I need to stockpile some money on the side for that real estate deal. And so this dwindles the amount of money that I'm going to have for dividend stocks next year. But what I'm going to do is I'm going to focus the money that I do have to deploy on dividend stocks. I'm going to focus it on high yielders. The reason that I'm going to do this is twofold. First and foremost, I want to get as much for my money as possible because I'm going to be deploying a little less money in the stock market next year than I otherwise would have because I have a strategic life goal of making my real estate business, my real estate dealings work out very well, which are another way of getting passive income as well. But because of that, I want the money that I am deploying in dividend stocks to work as hard as possible. And the harder it can work, the better. And I'm going to get my money to work harder by focusing on high yielding stocks. Also, it just so happens that I am at a life stage, married, 2 kids, lots of family expenses where we are starting to use some of the dividend income to pay bills. I see that trend increasing over time. And so because of that trend, I am drawn to these high yield stocks because I need current income now. And so that's how I'm looking at 2020. I'm going to share with you today the 9 stocks that I am focused on, and I'm going to share the complete methodology behind it. So get ready. This is going to be an exciting video about high yielding dividend stocks. All right, so I want to jump into the analysis. If you've been on my channel for a while, you know I'm all about the analysis. And so I'm going to work my way through the analysis to the conclusion at the end of the video of the 9 stocks that I chose. And so first and foremost, knowing that I had this strategic goal for 2020, what I did is I looked at all 43 stocks that I own and I picked all of them that have a starting yield right now of 4% or greater, because 4% or greater, that I consider in the range of my portfolio of higher yielders. Now, I know there's stocks out there that are yielding way more than that, but for me, I own 43 dividend stocks. I don't want to add more. And I focus on quality. And so I'm not only focused on high yield, but on quality. And I believe all the stocks presented today have both of those characteristics. And so you'll see on the screen right now the complete list of all of the stocks that I analyzed that met that initial filter of 4% dividend yield or greater. And you'll see if you count them up, if I have the Excel in front of me right now, the count comes out to 14. And so I actually eliminated 5 of these, but I kept most of them, which is interesting, as candidates for 2020. Now, mind you, I prioritize them, and I'll share the order of priority later in the video today. And so the first thing I did is I include just some simple metrics. What is the price per share? What is the current year estimated earnings per share? I pull the estimated earnings per share from Yahoo Finance, from the analyst consensus estimates. And then I just pull some simple forward PEs. Now, forward PE was not available on BTI or Cedar Fair just because these companies don't have analysts in the United States analyzing them close enough to be making those forecasts, or at least those forecasts are not available on Yahoo Finance. But all of the others had it, and so I include a forward PE. This is filter number 1. Yellow means it's okay. Green means that it's good. Red means that it's bad. You'll notice, though, that I actually assigned green to BTI just because I know their forward PE is low. In terms of Cedar Fair, I kind of left it blank. I would say their forward PE, the reason I left it blank, quite frankly, is PE is not a valid metric for Cedar Fair either because it's a master limited partnership. So it really needs to be analyzed on a cash flow basis. But I'll say, based on recent videos that I have produced and recent analysis I have completed, Cedar Fair right now, it's a reasonable value. Although I'll talk later about some challenges at the company that give me a little concern. Not changing course or anything, but I'm just being a little more hesitant on Cedar Fair these days. We'll get to that later. Anyways, you see off the bat that Duke, it's okay. It's got a PE in the 17s, more or less. That is okay in this market. Maybe a little overvalued, but hey, I'll take it. Altria is a bargain PE in the 11s. Philip Morris, I would say, for the industry that it's in, that PE is pretty high. In fact, it's kind of getting to the point where I may stop reinvesting dividends in this one, although I'm leaving it for now. BTI, we already discussed. Chevron, this is a pretty high PE of 18.55. I can't see myself buying Chevron there. Same with Southern in the 19s, pretty high. I can't see myself buying Southern in the 19 PE range. Bank of Montreal, reasonable PE there in the 11s. Royal Dutch Shell, reasonable PE there in the 12s. Universal, it's okay. That's why I made it a yellow box. But I'll tell you, Universal, there's a much bigger story behind this. Basically, it's trading at book value. And we've discussed this. I've discussed this with you all in previous videos. But again, on the PE metric, it's okay. BP is nice, 12. IBM, wow, in the 10s. I love this. And AbbVie in the 9s. I love you, AbbVie. I'm going to share on the screen right now. What did my family do last weekend? Hey, I dragged the whole family over to AbbVie Redwood City headquarters because I wanted to get a photo in front of the sign to show my support for all of the hardworking people, the employees, the leaders, the people working so hard at AbbVie on innovating medical solutions that benefit society. Thank you, AbbVie, and thank you for allowing me to invest my hard-earned money to support your cause, and thank you for rewarding me with dividends along the way. I love you, AbbVie. Anyways, in the 9s, PPL in the 13s. And so you quickly see just on the forward PE basis, some of these are in a reasonable buy zone, some are not. And obviously I adjust these green and red boxes a little bit for industry because different industries carry different PE ranges with them. And so moving on, I then just wanted to look roughly what percentage of my portfolio are these stocks right now and where do I want them to be? And so you'll see actually pretty quickly that some of them are already over allocated. Some of them are on point. Some are under allocated, although most of these are kind of over allocated is the sense I got. You'll also see here as a percentage of portfolio goal, I made some of them italicized. The reason I did that is some of the ones in italics, I actually changed the goals. If you've downloaded my full portfolio, I'll link in the description below how you can do so if you have not. But if you already have that, you'll know in my full portfolio, I have goals. I have various goals for different positions. Some of those I'm adjusting, and I'll talk about those in a minute. So Duke, thankfully, it's below allocation. I actually recently added some Duke not too long ago to the portfolio. I'm glad I did that. It's below, and so I give it a green. Altria, it's a little below, kind of on point, but I gave it a green. PM, way over allocated, so it's a red. And quite frankly, PM right now, trading at that 16 PE, hey, I'm not going to be buying more PM, although I'm happy to own it. BTI, gave it a red, it's a little over allocated. Chevron, red, over allocated. Southern, under allocated, so I gave it a green, although I don't think I'm going to be buying too much Southern here at these prices. Bank of Montreal, it's over allocated, but the percentage goal of portfolio here, I made it italicized. I think I raised it. I bumped up the allocation for BMO just because I have really low allocation to banks. And so I like that diversification. And so I think it was like 1% before, or less, a little less than 1%. I bumped BMO up. You'll see where it came from in a minute. It came from Cedar Fair. Royal Dutch Shell, over allocated. Universal, kind of on point, but over allocated. BP, over allocated. It's tough. A lot of these smaller positions, quite frankly, are over allocated. And so this is a conundrum for me. I have a lot of positions in the portfolio, core positions that I need to grow, but my focus this year or next year, 2020, it's not going to be core positions. Surely I will continue adding to 3M, for example, as we get into the new year, because I love 3M and it's still a value and I'll keep adding to it. And so that 2019 goal will probably push over a little bit into 2020. But in general, core stocks are not going to be my focus in 2020. A lot of these, the majority of the ones you see here, these are ancillary positions. A lot of them are already over allocated. But that being said, this overriding goal of yield, that's what's governing my decisioning here. So, IBM, it's right on point. In fact, I think I raised my allocation here to IBM. That's why it's italicized. Cedar Fair, right on point. I lowered my portfolio allocation to Cedar Fair. The reason that I did this is in the last few years, with all of the acquisitions going on, there's a lot of good activity at the company. The revenue top line growth is growing. It's up and to the right. Now, the distribution, the rate of growth of the distribution has slowed. And this is less than I would have expected because just a year or two ago, they said they were going to try to maintain long-term distribution growth in the 3 to 5% range or 3 to 4. The latest increase was a token increase. It was really slow. That alone doesn't bother me. But the reason it was slower is when I really dig into the numbers and I do my deep financial analysis that I've shared with you guys in previous videos, cash flow right now is not covering the full length of the distribution. That's an issue. Cash flow needs to cover the distribution. And so I want to wait. I want to see that snap back. Until then, I'll probably still add some more Cedar Fair because I have faith in the long term of the business. I know as a smaller company that just did a bunch of acquisitions, it goes through cycles. And so they're working through cycles. But I have to be careful, and that's why I downgraded the allocation to Cedar Fair a little bit. But I still love you, Cedar Fair. Still top 15 position, still solid 2% in the portfolio, which is a pretty big allocation for me. AbbVie, it's at a 0.9. The target is a 1. I love AbbVie. I just want to add more. I might bump up the allocation to AbbVie. It's such a good bargain, relatively speaking, right now. Given the strong starting yield, given the PE, given the dividend growth rate, given the payout ratio, and given their amazing pipeline. I would say the only thing bad about AbbVie is Humira coming off patent protection in the US pretty soon here, and the debt levels. But I think their pipeline, Allergan acquisition, all that's going to make up for it. So I'm buying more AbbVie. PPL, this one is italicized as well. I slightly increased allocation here as well. PPL is really small, so I'm happy I just bought some more PPL today, and it's still really small fraction in the portfolio. I need to bring that to size, and it's nice. It just so happens that it overlays with my strategic goals as well. Now, mind you, PPL, it's up quite a bit from where I first started buying it. I shared a video a while ago when I first initiated a position. I'll link to that in the description below. I wish it hadn't surged so much already, but I'm still buying here. I still think it's a reasonable value. Although we'll get to this later, all of these carry risk. And so risk with PPL is Brexit. All right. So I start looking now just at dividends. I'm going to keep scrolling over on my laptop on the analysis I'm looking at on the screen. I'm going to keep refreshing what you see so it moves over in the analysis. By the way, if you want to follow along at home, I'm just going to link to this thing in the description below. You can download it, enjoy it. You don't have to sign up for anything. Just go for it. I hope you enjoy the analysis. And that's one of the things that I'm trying to do on this channel is set the bar higher, provide the best quality content I can. And sharing these analyses is one way I can do that. So dividend yields. All right. As I look through these, I just kind of separated which ones are higher yielders, which ones are lower yielders. The ones in red are lower, the ones in green are higher. And so I guess I left some of them unhighlighted. Maybe those should have been yellows, but yellow doesn't really count here. It's really red or green. You'll see at the end that I tally the red and green cells to arrive at a conclusion on what to do. So yellow doesn't really matter. All right. Duke is a red. It's only at 4.25, but you see something like an Altria at a 6.71. That is green. And Chevron is kind of low. Southern kind of low. Bank of Montreal is low. More or less, everything else is really good. And so I don't need to go through them all one by one here, but I just want you to know that I did segment based on starting yield, because really the purpose of this for 2020 for me, for my specific situation, is I want starting yield. Yes, I care about dividend growth rates, but you'll even see in the next column, in the compound annual growth rate, I don't highlight anything because I'm not looking at future growth here. I'm looking at cash in the pocket now. That's what I'm looking at for 2020. And so you'll see on compound annual growth rate, some of them are really high like Altria. Some are really high like AbbVie. Some are a little bit lower like BP or Royal Dutch Shell, which is non-existent, or even BMO, which appears to be slightly negative. So that being said, the reason I didn't highlight this column with the red and the greens is I didn't want to really look for my goals this next year at growth rate of dividend. I'm more interested in starting yield. That said, some of this growth rate comes in through the next column, which is payout ratio. I look at the payout ratio, which is the annualized dividend divided by EPS, earnings per share. And it gives a sense of how much room there is to grow the dividend. Quite frankly, I think payout ratio is almost a better metric than the compound annual growth rate. They're both good, but the payout ratio, it's more forward-looking, because if something is already really high, like an Altria at 80% or 79.8, a payout ratio, do we really think this 10% compound annual growth rate is going to keep up in perpetuity? Probably not. It's probably going to slow down. And so that's why payout ratio, it's a little probably better way to look at it, because the lower the payout ratio, the higher the opportunity to raise dividends. Anyways, I did not put any red in the payout ratio column because I didn't want to penalize anything on payout ratio. Again, this is about current yield. It's not about penalizing stuff for lack of being able to increase dividends in the future. But I did give green rewards to some stocks that have lower payout ratios like Bank of Montreal, IBM, and AbbVie and PPL. Now, check this out. IBM, this is a stock that came up recently in one of the meetups, PPCE and meetups, and we're going to have more of these in 2020. 2019, I'm going to have a few more before the year ends as well. And if you want to sign up for those, by the way, I'll link in the description below. I have a local crew, California-centric, where we're doing the meetups. Sign up, you'll be alerted of when the meetups are happening. Anyways, IBM is a stock that was discussed. I own IBM. It got me thinking about IBM again, and as you go through this analysis with me today, you're going to see it's interesting. IBM, honestly, it is thriving on a lot of these metrics that are aligned with my personal 2020 strategy. Okay, so next what I do is I look at position number. As you know, I generally like to add to my core positions, my ancillary positions. They're not as important or relevant to me. I own 43 stocks. I'm trying to, 2019 was all about building the core, but honestly, that's a philosophy that carries through to the future. And so I wanted to pay respect to my 2019 goal here by looking what's a core position, what's not. You'll see the lion's share of what I'm presenting today are red cells, meaning they're not even in the top 15. Everything that's green is in the top 15 for me. Duke, Altria, Southern, and Cedar Fair. These are my only top 15 companies that make this list. And so most stocks here got penalized, and I wanted to at least reward or pay respect to stuff that is in those top 15, because for me, it will always be an exercise of focusing on the core for my portfolio. That was my pure goal in 2019, but it kind of always carries through to future years as well, because I want a core-centric portfolio. I want to double down, if you will. Another way of looking at it is doubling down on the real winners. It's nice to have ancillary positions, but I can't lose focus on the winners, the core. Okay, you guys know I love international exposure. I pulled in these numbers from an analysis I shared before. I'll link to it in the description below. I looked at all my companies and I looked which ones, what is their international exposure by revenue. And so here I give green, I reward those stocks that have a lot of international exposure, and I give red to penalize the ones that don't. And I give, I guess, yellow for the one that is kind of in the middle. But you'll see quickly stuff like Duke, Altria, Southern, these are all U.S. Cedar Fair, all U.S., so they get penalized. But stuff like Philip Morris, hey, it's 100% international, so it gets a real green highlight there. But some of these others that you may have not thought about, Chevron, I wouldn't have thought that was 69% international. This is why it's so important to look at the numbers and not always trust the gut, because the numbers will surface things that intuitively you would never think about. I would never think that Chevron's business was so focused internationally. Royal Dutch Shell, I would have thought that. Universal, I would have never thought this. 82% of their business is international. That is awesome. And so I just bought some Universal. It's always fun to buy Universal because it's one of the smallest companies I own, trading around book value. It's not really growing, but I buy it as a bond proxy. I buy it for the dividend. I also don't think it's going anywhere. And so, yeah, IBM is another one, 63% international. I told you IBM, it's going to be a theme throughout this. Wouldn't have thought that. PPL, I knew it was, I knew this, but I'm just reminding the community. It's so interesting that they're UK heavy, but this is a risk as well, because there's a lot of talk in the UK about nationalizing the utility system, and boy, that would throw a wrench in PPL's game plan. So there's certainly some risk at PPL, but I'm shouldering it. I take calculated risk. That's how I have historically won in the stock market. So I'm going to keep moving along. Let's look at book value and price to book. And so, again, as I scroll on my computer, there's going to be a series of new screenshots coming out. You guys could follow along on the screen or download it in the description below. I pulled the book value for all this. I don't usually look at book value. I've even said so far in the past, is book value, it's not really relevant to me. Certainly it is in industries like insurance and banking, maybe utilities a bit. But certain industries like consumer non-cyclical doesn't matter at all. Now, the reason I pulled book value in here is I realized off the bat, hey, my tried and true consumer non-cyclical stocks, they're not making the list for 2020. I'll be reinvesting my dividends in them, but I'm probably not going to be buying a lot of net new shares in 2020 unless a sale comes to fruition. I always will be ready for a sale. Everything is fair game in my portfolio, or even outside my portfolio, if I see a one-time bargain basement sale like I did with 3M in 2019. But, basically, if you look at this right now, you'll see, unfortunately, 2020, there ain't a lot of consumer non-cyclical on here. And so the reason I incorporated book value in this analysis is these are the type of stocks where book value actually means something. And so book value, by the way, is assets minus liabilities. It's what's left. It's the shareholders' equity. And it's basically what's left if the company kind of goes out of business and liquidating assets and such to common shareholders. What's left for them? Altria, I guess, is one where it's a red, obviously, on the price to book, but that's a consumer non-cyclical. And so price to book value doesn't mean a whole lot for Altria. It's a different type of business. Probably IBM book value doesn't mean a lot either. But basically what I wanted to do with this column, honestly, is reward some of these companies that do have a good book value. And so you'll see stuff like Duke, like BTI. That was really surprising on BTI that it was such a good price to book, especially being a consumer non-cyclical. That's awesome. Chevron. You see Royal Dutch Shell, Universal. Here's where Universal comes up again. It's basically trading at book value. That's why I feel comfortable deploying money in it here, and I just did. That was just a little tangent into book value. And something I want to point out too is when you're doing these analyses at home, sometimes it makes sense to pull in numbers that you might not normally look at. And so each time I do one of these, each year that passes, each strategic goal that comes up, I try to change it up a little on the numbers I'm looking at just to keep the mind sharp and to try to look at things with different perspective. And that's why I included book value here. Market cap, I didn't really want to penalize stuff that's too big because everything in my portfolio is big, but I wanted to include some green highlights, some rewards for the small caps because I got to show my love for the small caps like Universal, Cedar Fair, and PPL. This is the market cap in billions. I did a really down and dirty subjective analysis of debt, and I pulled up the debt for each of these companies, and I take the debt as a function of the market cap. Now, this is a risky way of looking at it, or not risky, but it's a non-perfect way of looking at it. It would be better probably to look at debt as a function of earnings or debt as a function of revenue, because market cap can fluctuate. And market cap is a byproduct of share price. And we know that the markets are generally not efficient. At least that's my belief. For this analysis, I'm making the assumption that the market is efficient and that the market caps are indicative of revenue and earnings accurately. And that's why I'm looking at it this way. It's a down and dirty metric. That being said, the wisdom that I want to impart to the community is sometimes that's okay to do down and dirty analysis because it gets you to the number quickly. It gets the answers that you need so that you can move on with life and not get caught up in analysis paralysis. And so anyways, I look at these and I didn't really want to penalize anything because quite frankly, interest rates are low. They will probably continue to be low because if they go up, it's going to cause a massive issue. It's going to cause the next major recession or even depression. And I think the government, the Federal Reserve, realized that. I don't think interest rates are going anywhere. And so companies are incentivized to borrow. And so I don't want to penalize necessarily for borrowing. Generally speaking, I don't like to have companies in the portfolio that are egregious with debt, although I'll say if there are any that worry me a little bit, maybe something like an AbbVie or an IBM, although IBM, a lot of their debt is because they finance customer purchases, and so it's lending arm debt, which is different from long-term liability debt. But needless to say, I have a few in here that have some debt concerns, but the way I shoulder the risk is I diversify across 43 and I only own world-class companies. But needless to say, what I want to do here is I want to reward companies that have low debt. And so I was looking, Altria has low debt, PM has low debt, Chevron has low debt. Let's just give a shout out to those companies, a green highlight to those ones. And so I love this next column because the next column is the subjective one. How do I just feel about it? Everything so far has been quantitative, but when I'm looking at companies, I also need to know, how do I feel about it? The way I invest, it's like a marriage, if you will. I am marrying these companies forever. I am buying, I am never selling, and I am marrying it not only for myself, but for future generations. This portfolio will be passed on, and so I want to buy stuff I feel good about owning because it incentivizes me to stay on the path, to stay focused, to stay committed. How do I feel? Well, I feel good about Duke and Altria. I feel bad about Philip Morris. I don't like it here. It's too expensive. I feel bad about BTI. Honestly, it's harder to analyze BTI being a foreign company. The reporting in the US I find easier for myself to analyze because that's my bread and butter, what I'm used to analyzing. And I got enough. It's overallocated. I feel bad about Chevron. I feel like it's overvalued. I feel good about Southern. I feel okay about some of these, like Bank of Montreal, Royal Dutch Shell, Universal, BP. I feel okay. Why do I feel okay about some of these? It's a different situation for each, but I'll tell you, like Royal Dutch Shell, BP, The reason I don't feel good about them is, quite frankly, our dependence on oil over time may be dwindling. I love driving sports cars, gasoline-driven motor vehicles, but I'm old school. A lot of people want the new thing, which is all electric. Now, mind you, oil is used for so many things. It's used for producing plastics. It's used in manufacturing. It's used in aerospace. And the worldwide population is growing. And so I don't think there's any concern short-term for BP or Royal Dutch Shell. That being said, I feel okay about them because I never wanted a huge allocation in my portfolio to oil. And usually I only buy oil when they are on steep discount. They are just really hurting. And so I did a whole series on oil stocks. I'll link in the description below about how I look at oil when I buy oil. Now, in the market cycle for oil, it's usually not around the time I buy oil. So that's why it's an okay. But at the same time, I'm hunting for yield. This is an overvalued market. There ain't a lot of good yield out there, and I'm only seeing it in oil. And so it's kind of a paradox here. It's like I don't want more oil. It's okay, but it's honestly one of the only values out there right now. So that's how I'm looking at oil. IBM, I feel good about it. I don't have a lot of tech exposure, and I feel that it's got a lot going for it, as we've seen in the analysis so far. Cedar Fair, I feel okay. Honestly, I brought this stock up to about 2% of my portfolio. And originally I was going to add a lot more to it. I probably still will. But I feel okay for the reasons already mentioned. I don't feel good about their cash flow right now. I'd like them to get their house in order. But oftentimes it's too late. Once they get their house in order, it won't be on sale anymore. And so this is another huge takeaway. Sometimes I take calculated risk. I probably will buy more Cedar Fair throughout 2020. Why? Their house is not in order. Cash flow is messed up. When the cash flow is messed up, that gives me an opportunity to buy on sale. Once they fix all that, stock's going to be through the roof. And so that's a really, really important message, and for myself, quite frankly, because I need to remind myself of that. AbbVie, I feel good. I feel good about you, AbbVie. Thug life. I love you, AbbVie. PPL, let me just say something. These companies in the media, big pharma, gosh, someone shared on my Facebook today something. I don't know what to do on Facebook anymore. I'm not talking about my group, which I'll link to in the description below, by the way. I love the group. I'm sorry, I have about 200 pending invites I haven't had time to get through. I will get through them. Thank you for being patient. I love my Facebook group. I'm talking about my personal Facebook. And can I just talk a minute? I live in California. I grew up with a lot of people who kind of subscribe to the general philosophies, political philosophies that are popular in California. And look, I try to stay unbiased. I don't want to talk about political views one way or another. But I'll tell you, I see something. I wake up this morning, someone's talking smack about my holding that I own. I think it was Pfizer. And let me just write that down because I'm going to have to do disclosures later and I don't want to forget it. But talking smack about Pfizer. I love you, Pfizer. And what they were saying is, CEO's getting paid too much money and the prices of their products are too high. I'm just saying, these companies get so much bad press, but we should also think about the value they're bringing forth. A lot of these companies are driving medical innovations. They have scientists who are very expensive, very well educated, who need to pay back their student loans, quite frankly, who need to make a lot of money to pay back their PhD programs and their years of research to get to these solutions that they are producing. And so all I'm saying is there's two sides to every story. And because AbbVie, companies like that, they kind of get a bad reputation sometimes in the media, I give them nothing but love. I give them so much love because I want you, if you work at one of these companies, rest assured that your shareholders love you. And quite frankly, I imagine, I can't speak for them, but I imagine a lot of your patients that use your solutions that have helped their lives, they love you too because you have provided an advance in medical technology that has helped people. And so I know there's two sides of every story, and sometimes it's hard for others to see these headlines about what CEOs are getting paid. But I just like to give love to this stuff because they never get love. So I feel good about you, AbbVie, just as I feel good all day, every day about Sin stocks. And I started my portfolio. I built a foundation on Sin stocks back in the day. Everyone loves to hate them. I got nothing but love. PPL Corporation, man, I just feel good about it. I feel good about it because I know it's a calculated risk. I know It's gone up, but it's still trading at a discount. And got Brexit drama. I like to buy when the drama's there because it creates opportunity. Although if the drama comes to fruition, it could create big risk, but I'm willing to shoulder it. All right. So now that I've gotten through the subjective stuff, what I did is I counted up the red boxes and green boxes for each of them. And I kind of did some subjectiveness here. Like green, my average was a 2.71. So on average, red. On average, each stock that I covered here, all of them, got an average of 2.71 red boxes. So the ones that got lower than that are better off. The ones that got higher are worse off. So you can see quickly, oh, Philip Morris, 5 red boxes. Sorry, I'm not going to be buying that. But, oh, Altria, 2 red boxes? Yeah, I'm gonna consider buying that. Oh, Cedar Fair, only 1 red box? Yeah, I'll buy some more Cedar Fair. AbbVie, only 2 red boxes. Yeah, I'll buy some more AbbVie. But Southern Company, 4 red boxes. No, I'm not going to be buying more. So that's how I looked at red boxes. Green boxes, I added them up. The more, the better. The average was a 3.93. 6 green boxes for PPL. Thug life, you're on PPL. Only 3 for Southern? Sorry, Southern, not enough green boxes. Basically, what I did is I took these calculations of all the red boxes and green boxes. I moved them over to the next column is, will I be adding more? And I came up with 3 general buckets. Yes, some plus, which was kind of a differentiation if it's in the some category, but it's better, and then no. And so, for example, Altria, I'll be adding some, a little more than some, a some plus, because I love you, Altria. Duke, some. I'll add some to Universal. Yeah, IBM is a green yes. I add a lot to IBM. Altria, AbbVie, PPL, green. I'll add a lot. And so that's how I did it. I also include just some subjective columns at the end here, just that you can see, am I already reinvesting or not? I'm not going to really change my reinvesting preferences right now, but I will probably pull out reinvesting from a lot of these stocks at some point in the near future because they're not strategic. Most of them, especially the ones here that aren't strategic, especially ones like say PPL, for example. I love you, but once you're at size, you're non-strategic. I stop reinvesting. I use the cash flow to pay bills. I love it. I talk about some of the risks here. Risks generally fall into the buckets of sin stock, oil stock, stagnant revenues, deteriorating fundamentals, so on and so forth. I've already hit on a lot of this, but you'll see it in the spreadsheet. And so I want to show a summary here. This is Ian's 2020 high yielder shortlist. You see here stack ranked orders 1 through 9. These are the 9 stocks I'm going to be focused on in 2020. And it starts with an AbbVie, which is my number 1 focus, PPL number 2. And you may think, Ian, AbbVie, you're adding more? You're already up a bunch. I don't care. I'm happy to average up. It's still a value. I'll average up. I'm fine with that. IBM, number 3. Altria, number 4. Cedar Fair, 5. Duke, number 6. Universal, 7. Shell, 8. BP, 9. You'll see I left oil for last because, again, these oil stocks, I don't want so much allocation, and it's not the right point in the oil cycle to be buying, but hey, I'll do it. I'll probably buy a little just because that's where the market's at. And if I have this goal of the high yielding stuff, that's where the high yield and the value is right now. Anyways, that's my list, and the simple average of all these is a 5.8%. That's the number 1 number that motivates me. I just buy this basket. I am yielding off the bat, day 1, a 5.8% yield. In a market where most of my core stocks that I love, my consumer non-cyclicals, they're below 3% at this point. They're in the 2s. And so getting in the high 5s as a starting yield with world-class companies that I've already vetted, that are in the portfolio, that I love, that I feel confident about, I just feel good about this strategy for 2020. I feel good about it, and I feel good about it because it works for my life situation where I'm at right now, where I need to save some money for real estate. I need to continue. I'm getting closer and closer to semi-financial freedom. Certainly full financial freedom is a way out, but I'm getting closer and closer to more semi-financial freedom where we're using more dividends to pay bills. And I'm at a point where I need my money to work for me because I'm putting less money in because I'm saving a lot of money for real estate. And so that's where I'm at. that's my list. That's my strategy for 2020. I would be so curious what you all think. Share in the comments below. Every comment means the world to me. Comments, likes, subscriptions. It's the best way you can thank me for my hard work here on YouTube. I love you all. Share what you think below. And look, this is my strategy. It's very specific to my personal situation. I imagine a lot of you out there have a completely different personal situation. Share in the comments below. What's your situation? What are your goals? How do they differ? You may have a different life stage that you're in. You may have a different stage of your portfolio, different family situation, different career situation. You may be doing something very different in 2020. I would love to hear, because the best part about this channel is all of you. It's the community. It's the discussion that we have in the comments below. It's the discussion on Facebook and social media, Instagram, Twitter. I love you all. Thank you so much. All right, before I leave today, I do want to go through my disclosure. In terms of full disclosure, I am long the stocks mentioned today. I am long Duke Energy, ticker symbol DUK, Altria, ticker symbol MO, Philip Morris, ticker symbol PM, BTI, ticker symbol BTI, Chevron, ticker symbol CVX, Southern, ticker symbol SO, Bank of Montreal, ticker symbol BMO, Royal Dutch Shell, ticker symbol RDS-A, Universal, ticker symbol UVV, BP, ticker symbol BP, IBM, ticker symbol IBM, Cedar Fair, ticker symbol FUN, AbbVie, ticker symbol ABBV, PPL, ticker symbol PPL, 3M, ticker symbol MMM, and Pfizer, ticker symbol PFE. I own all of those in my personal stock portfolio. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest, please consult a licensed financial advisor first. Just sharing my personal journey here on YouTube for fun and entertainment. By the way, before I go, bonus content. The reason I own RDS-A instead of B, I own the A shares, is historically speaking, A has referred to the oil deposits in the ground, where B has been more about their refining business. So they kind of divvied up the business along these classes, and there's different tax consequences for each. Personally, I was willing to take on more complexity on the tax side of things for the assurance that my A shares were actually secured by the oil reserves in the ground. At least that's how I've looked at it historically. And so it doesn't really matter. A lot of people go for B because it's easier on the tax side of things. But that's why I got A, because I know a lot of you ask that sometimes in the comments below. By the way, I have some really cool merch in my store. You'll see a link to that in the description below. A lot of that makes great gift for the dividend investor out there for the holiday season. I'm so incredibly blessed and thankful for all of the orders that have already come through. Thank you so much. It means the world to me. Brings a smile to my face. Helps me, helps the channel, supports the production, the equipment, the time, all of that. So thank you so much. I am wishing you an amazing holiday season. Happy holidays, everyone. I will see you in the next video.